Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, who is to blame for the stock market's wild swings? Answer by Daniel Sasse. Over the years, stock markets have been embroiled in political debate and thus media scrutiny. What happened to the markets being the last frontier of capitalism, rather than a place that people expect to be safe, where there are only winners? I believe markets go up and down as they should depend on the volume of sales. This could be measured or a bullet to the head situation, that is thrill of investing. That said, I would not blame anyone. Folks want me to say this HFT or some rogue trader, but in all honesty it does not matter. The fact is investors are buying to high, the smarter players now want to sell, the algos want to sell, so there will be movement. This is amplified by political fear and general investor panic. If I was forced to blame someone, I would have to say the public. If the public was well educated and left the market when they should, then there will be no flash crash. Rather, we would have stable markets that go nowhere as all information would be known. The myth of EMH. In short, we all have to get over it. Markets are crazy and emotional. Answer by Glenn Kaiser. This was a three-way train wreck where all deserve some blame. Individuals were throwing money into the market at an unsustainable rate since last November, driving it up to an overbought condition. This is a red light for market analysts and money managers, because volatility, the VIX, had been so low. Money managers, hedge fund managers, banks and even pension funds had been loading up on a number of low-volume ETFs, VXX, UXI, TVIX, that used leverage to double or triple their returns. Many of these money managers and hedge fund managers were buying these ETFs on margin, which means when the VIX goes up, they have to scramble to raise cash to cover their margin call. That means selling anything they can to raise cash, like the QQQ and SPY and gold. The last unemployment report showed not only low unemployment, but increases in wages, making economists worry that the inflation was coming back and that the Fed would raise interest rates higher and faster than planned. The 10-year bond rate jumped to 2.85%, approaching the 3% magic level. All of these groups combined to sell into a market that was too high, driving it down with amazing speed. Essentially, these ETFs caused a flash crash, and programmed computer trades just kept selling and selling. No human was at the wheel. That scared big money managers to sell off their winners and go to cash. Recent investors, Category 1, who had thrown money in at the top, reversed course and sold out, taking big losses. Eventually it was the owners of these leveraged ETFs that had to finish selling and getting out, so that the VIX could return to normal levels. There will be more volatility and selling because the inflation picture seems real. It won't be a steady uptrend like it was in 2017. In this market, the index funds are not as attractive as individual safety stocks. But in reality, when we have a flash crash, everything gets dragged down together. Answer by Jeffrey Weber. Greedy investors to start with who think the rules of investing are suspended every now and then. Stock markets always go up and down. So you need a way to invest that takes into account the fact that markets do go up and down. And down can be very good for long-term investors. I started with American Express in 1994 and still have it 24 years later. Thanks to the dot-com bear market in 2003 and the financial meltdown in 2008 to 2009, my American Express stock is up from $1,500, $750 cash, $750 stock shares, to over $25,000. I was able to buy shares of Express at $9 a share in 2009, 9 years ago. Now Express is $95 a share. The herd always overreacts and drives lower than they should go, creating great buying opportunities for smart, logical, contrary investors like me. If you wasn't be a good contrary investor, order my book, Here Are the Customers' Yachts by Jeffrey Weber, available on Amazon, and receive free newsletter subscription.